The LME signaled plans to introduce pricing for sustainably produced base metals copper, aluminium, nickel, zinc, etc. that would allow lower carbon production to trade at a premium to conventional metal. The proposal includes clear carbon intensity thresholds and the possibility that premiums may be published as zero where markets don't support a differential. This creates a pathway to monetize decarbonization in mining and smelting, but brings challenges in measurement, verification, and liquidity for the new benchmarks. Why it matters. It changes how metal value is captured across the supply chain. Miners and refiners that decarbonize can potentially earn higher prices, while consumers gain clearer signals on low carbon sourcing. 2. Processing and smelting capacity. The midstream are now strategic choke points. Speakers repeatedly stressed that security of supply depends less on ore in the ground and more on the ability to process and refine it. Dominant processing capacity in a single region creates vulnerability. At the same time, treatment charges and smelter economics are under stress in markets with oversupply of processing. The industry is moving toward tolling and bespoke processing agreements as standard structures, rather than relying solely on traditional benchmark charge models. Why it matters. Control of processing capacity, not only mining, will determine strategic advantage and where investment risk and returns sit in the metals value chain. 3. Copper bullishness. Demand growth versus constrained supply. Copper emerged as the most bullish metal on participants' minds. Long-term demand tied to electrification, data centers and infrastructure is seen as strong, while supply and processing constraints pose upside risk to prices. This sentiment was reinforced by rising regional delivery premiums and cautious producer positioning. Why it matters. A sustained copper rally would reflect broad industrial trends, electrification and green transition, and could trigger investment shifts, supply chain adjustments, and price pressure for downstream manufacturers. 4. Aluminium. Turning from chronic oversupply to cautious optimism. Aluminium markets showed signs of rebalancing. Where analysts had recently been uniformly bearish, several are now forecasting a potential price rebound driven by limited expansion of smelter capacity in major producing regions and rising global demand. The market is no longer taking abundant supply for granted. Why it matters. Aluminium price recovery would affect a wide range of industries: automotive, construction, packaging, potentially increasing production costs and accelerating interest in recycling and low-carbon aluminium options. 5. Spotlight on critical, exotic, metals and supply chain fragility. Beyond the big base metals, the week highlighted rising importance and vulnerability of specialty metals such as germanium, gallium and other critical inputs for semiconductors, defense and advanced technologies. Export controls, concentrated processing, and geopolitical risks have pushed prices and risk premiums higher for many of these niche commodities. Why it matters. Industries that rely on small but strategic metals must reassess sourcing, inventories, and substitution strategies. National policymakers may also prioritize domestic or allied processing capacity to reduce exposure.